Good afternoon, everyone. On behalf of Amity Innovation Incubator, I extend a very warm welcome to all our founders, entrepreneurs, students, investors, mentors, and ecosystem stakeholders joining us today. I am Tulika Chaudhary from Amity Innovation Incubator, and I'll be your host for today's session. Before we begin, let me briefly introduce Amity Innovation Incubator. Established in 2008 under the visionary leadership of our president, Dr. Aseem Chauhan, Amity Innovation Incubator was founded with a mission to strengthen India's innovation and entrepreneurship ecosystem by providing comprehensive support to startup from ideation to scale. Today, we are proud to be recognized as one of India's leading startup incubators. We are supported by Niti Aayog under Atal Innovation Mission as an established incubation center and have also received support from the Ministry of Electronics and Information Technology, MSME, and DST. Over the years, we have supported more than 1,100 startups across diverse sectors and invested over 65 ventures through Amity Capital Ventures, our investment vehicle with more than a dozen exits to our credits. Coming to today's session, fundraising is often viewed as one of the most exciting milestones in a startup's journey. However, being truly investment ready requires much more than a great idea or a compelling pitch deck. Founders need to understand the legal, financial, and strategic consideration that shape successful fundraising outcomes. To help us unpack these critical aspects, Amity Innovation Incubator, in association with Sigma Chambers, is delighted to host today's session on fund readiness for early stage startups. This session has been designed for startup founders, leadership teams, and aspiring entrepreneurs who are preparing to raise capital or simply want to better understand how investors evaluate opportunities. It is now my pleasure to introduce our speakers for today's sessions. Joining us first is Mr. Abhinav Goyal, partner at Sigma Chambers. Abhinav brings a unique founder side perspective to startup fundraising and venture transactions. He has been a founding team member of and a general counsel for Hunch, a consumer social dating platform, PlotX, a Web3 prediction protocol, and Hillroute, a regulated digital assets hedge fund. Today, he serves as fractional general counsel to several emerging and mid-market technology companies. His hands-on experience in negotiating investors' rounds, building legal infrastructures, and managing fundraising processes gives him deep insight into challenges founders face while raising capital. We are also joined by Ms. Smriti Poddar of Counsel at Sigma Chambers. Smriti advises private equity and venture capital transactions, mergers and acquisitions, and financing. She works closely with founders, boards, and investors on deal structuring, cap table, cap table transitions, FEMA compliance, investor documentation, security creation, and due diligence process. Her extensive experience representing both investors and companies provides valuable perspectives on what it takes successfully navigate fundraising transactions. Together, Abhinav and Smriti brings a powerful combination of founder sides, investor side, and legal expertise, making them uniquely positioned to guide startups on their fundraising journey. For the participants, in case you have questions during the session, I would like to request you all to post them in the chat box. We will take the questions in the Q&A section. Ladies and gentlemen, please join me in welcoming Mr. Abhinav Goyal and Smriti Poddar for today's session on fund readiness for early stage startups. Over to you, Abhinav and Smriti.
Thank you so much, Tolika. And many thanks to the Amity Innovation Incubator team for organizing this super important session. Um, so, the question that I want to start with today is a very simple one. As a founder, are you really ready to raise? It's a question that I think every founder should be asking themselves before they start pitching to investors, but it's not asked as often as I wish it was. You can have the best deck, you can tell the best story, and you can still have the deal fall apart during due diligence or during negotiation of the shareholder agreements. What will get your round closed smoothly is when the investor is looking into your company records, everything is held up, and there are no skeletons that are falling out of the closet. Now, everyone usually likes to talk about the exciting part, the pitch, the deck, getting investors excited about what you're building. But today we'll focus on what happens once they're actually interested in investing in your company. The part which gets usually sidelined when everyone is focusing on building the product and thinking about where to deploy the funds once the money hits the bank. So we'll start off with how the process of getting funded actually looks like. It's not a single event. It's a step. It's a series of steps that you can see on the screen. Um, it starts with identifying the right investor, and this part is really about the fit between the investor and the founder and the startup. You have to be pitching to investors which are investing in the stage that you are at currently. You have to check that they are backing startups in your sector, and you have to also ensure that their investment thesis actually matches what you are looking to do. So, therefore, before you actually start talking to them about their check size and the valuation that you're looking to raise at, there has to be a match between you and the investors. So, as an example, a deep tech investor which is deploying from a fund which is mandated to invest only in deep tech companies will not be investing in your company if you are a consumer brand, right? So, once there is a match and there is an alignment on the check size and the valuation, you will move into the preliminary due diligence stage. This is typically a light review to check that. From the investor side, they'll be checking that the money that they're going to be putting into your venture can actually be multiplied, and you are actually going to fit their investment thesis. And they're going to ensure at this stage that their time will be spent, and the time and money will be spent very well if they go into this process. Now, if that is the case, then they'll proceed to send over a term sheet. This is where there will be the key commercial terms that are going to be agreed between you and the investor. The valuation, the size of the round overall, the main rights that the investors are going to get in your company. But it's important to remember that the term sheet itself is not money. It's just a statement of intent. The money is still going to be a couple of months away at best. Once the term sheet is signed, you will proceed to open up your data room and hand over your documents. And then the investors, lawyers, and accountants, they'll proceed to go through all the documents that you've provided them as a part of the confirmatory due diligence. This will have everything that you've built over the years, all the details about your products and services, every contract that you've entered into with your customers, your employees, with your vendors, every IP filing, all of these things get examined at this stage. Then, if the due diligence goes well, you should expect to receive a draft of the definitive documents, which are the shareholders agreement and the share subscription agreement. This is where you should expect most of the negotiation between you and the investors to happen. Um, these are the documents that will form the base of your relationship with your investors. Once you're done with negotiations, you will start moving towards the closing of the transaction. But before the money hits the bank, you will have to comply with a list of to dos, which are called the condition precedent. These have to be completed before the money is actually hitting the bank or the transaction documents are signed. Once these conditions precedent are cleared and the documents are signed, then the money will get wired to you, it will get transferred to you, and the share allotment process will start. Thereafter, we will reach the closing date. However, it is important to understand that even then, all the steps that are to be taken as part of the process, they are not yet over. What you'll see on the screen, the step 9, which is condition subsequent. Um, what a lot of founders don't realize is that even after the money is in, uh, there are still a lot of steps that need to be complied with, and these are there as a part of the share subscription agreement or the shareholders agreement, where you are required to give comfort to the investors that whatever turned up in due diligence, which was either covered in condition precedent or condition subsequent, is actually carried out with. And these documents also contains language that in case you do not comply with those steps, you would have to return the money. Now, for the rest of the session today, I would want you to hold on to this point because it's going to link. It's going to be linked to everything that we're going to talk to you about. Um, every gap that you carry into your data room will essentially become a condition precedent or a condition subsequent. What this means is that if there are any gaps in terms of your IP, your customer contracts, or your co-founders agreements, etc., these will need to be addressed. They will in fact even become things where investors might want to take a relook at your venture if they are not complied with, right? So now let's go on to talking about these gaps, and the first one is the most basic one of all. Here we'll be talking about whether you have the right entity set up, right? That is the first thing that the preliminary due diligence looks at. What we see very often is that founders start off with an LLP, a limited liability partnership, and I can understand why that happens. An LLP is typically easier to run. The cost is lower. There are only a couple of filings that have to be done in a year. If you're running a consulting firm, or you're running a training business, um, something where you're not typically looking to bring in external capital, an LLP is perfectly fine. But the moment that you decide that you're going to raise external capital and you want external investors on your cap table, an LLP is not going to be the right structure, because a fundraise requires certain documents, and a startup, as we understand it, requires certain documents to be issued, which an LLP just cannot do. Now, these include the preference shares that have to be issued to the investors. These are the convertible notes, which will eventually convert into equity shares. Then there are the ESOP policies that we all keep hearing about. All of these things require a private limited company. Now, so therefore, an LLP cannot really give to an investor what they are coming for, which is to get a share in the upside through the deployment of their capital. Now, very recently, we had a situation where an investor was ready to send the term sheet after having, gone through the pitch with the founders, multiple rounds, and the process was about to start. And they simply asked for the company's details. When they asked for the company's details, it turned out that this was an LLP, and that itself delayed the round by a couple of months and put the startup's finances into immense pressure, because they were hoping to be able to close the round, raise money, and deploy it quickly because of some orders that they had to fulfill. And now it's, as you can see on the screen, it's not just the entity itself that you have to be careful about. It's all the basics around that entity. You have to have your statutory records organized. Now, this means the MCA or the ROC filings that are there, these have to be filed and up to date. Your board meetings should be held at regular intervals. At least 4 board meetings in a year are mandatory as per law. The board minute meetings should be there and record. This is something that we find very often are not maintained. And but so these are the things that overall will go on to show an investor that there is good governance that is being practiced by the founders, and this will give them overall confidence to invest in you as well. Now, the second thing that the due diligence looks at is whether your registrations, licenses, and your customer and vendor agreements are in place. Let's start off with registrations and licenses. These are usually triggered by things like your headcount, whether you've crossed 10 people, 20 people, and so on in your organization, by your revenue, which is what triggers your GST, and by the states that you operate in. So, for example, Shops and Establishments Act registration is done on the basis of the state that you are in. The professional tax registration is professional tax as a liability. It's there only in some states. So if you're operating out of Bombay or you're operating out of Bangalore, this is something that you and your employees will have to adhere to. Provident fund is something that kicks in once you've crossed 20 employees. ESIC registration and compliance kicks in once you are 10 employees or more. Now, the mistake that we see founders make most often is assuming that these are either not applicable to their business or that they can push this compliance to a stage when they are already funded. And that's something that we saw earlier this year. When we got the due diligence document, we were doing a due diligence on behalf of the investor. And when we asked for all of these compliances, we kept getting told by the founders that they will do these compliances once the funding round is over. So that meant that we had to stop the negotiation of the terms of the agreement, and had to tell them to get certain registrations in place. So some of the things were moved into CP, which is condition precedent, and some of the things were moved into condition subsequent, depending on their importance to this startup's business. Now, the second bucket that you have to be careful about is your customer and vendor contracts. When an investor's lawyer goes through these, they're reading for very specific clauses. They're looking to understand the termination and notice periods. They're looking to understand the liability that you have, the indemnity that you're giving to the counterparty, and vice versa as well. If you have a vendor whom you're taking services from, do you have the correct indemnity from their side? Are there sufficient confidentiality clauses? Is there any exclusivity clause that is there? And are there rights to assign the contract and the IP itself? So, for example, if you're building something where the IP itself is your moat, and you've signed an agreement with a customer promising them any level of exclusivity with respect to the product to which you are pitching to the investors, that contract will very likely have to be amended as a mandatory step prior to closing of the transaction. Another example which will perhaps help understand the importance of a well-drafted contract is what we've seen very recently, where we were advising a tech company which was building software related to automobile industry, and some listed companies were their customers. These agreements with the customers allowed the customers to terminate the contract without firstly any notice, even though there was substantial investment on part of the startup to provide these services. And secondly, the startup was in fact restricted from utilizing the deployment learnings to enhance software quality. What this means is, in practice, is the startup has made a software, it has deployed it on the customer side, and there's ideally going to be getting a lot of data from the day-to-day deployment of that software. But whatever data that they're getting, that can only be used to service that customer. They cannot make any improvements. If they see a bug, or if they feel that that data can be used to make a new feature, that is something that is not allowed. And now these had a major impact. These two clauses in these agreements had a major impact on how the investors viewed these contracts. The third bucket is the general tech and data compliance, which is pretty important in any diligence that is conducted by investors. Now, there are privacy laws which are in force, which you all would have heard of in different places. There is the Information Technology Act, and then there are the intermediary guidelines if you happen to be an intermediary. Now, as far as privacy laws are concerned, if you're handling any personal data, and most of the startups do so at some level, compliance is going to be now mandatory and will increasingly come up in conversations that you have with your customers. Now, so the bottom line is that you have to pay attention to all of these aspects that are there that we're talking about today from day one, so that you're not having to hurriedly apply for registrations, like the example that we spoke about, or trying to renegotiate your multi-year or year-long contracts with customers just so that your investors feel safe, and you can close the round. The next thing that diligence digs into quite a bit, and for many businesses this is going to be super important. That's your intellectual property. The question an investor asks is very simple: do you actually own what you say on your deck that you own? To understand this better, let's break up IP into four parts, right? These are the major kinds of IP that we come across. First is trademarks, which is your brand identity, your name. The mistake here that we see commonly is that founders often file trademarks only for their logo and not for the name of the brand itself. So what happens then is that you run the risk of somebody else actually using your brand name with a different kind of a logo, different stylization, and so on, and creating confusion amongst your customers. And you won't have the ability to make them take it down because they registered it before you, even though you had been using it for a longer time. The second kind of IP is patents. You can file for patents if you have made something which is novel, which has an inventive step, or has industrial application or utility, as we call it. The classic mistake that we see here being made over and over is that the patent gets filed in the founder's name, founder's personal name, rather than the company's name. So essentially, what is happening here is that the company doesn't own the core invention that it is selling to its customers as its proprietary technology, and that's in fact held in the name of one of the founders. And in cases where there are disputes between the founder, these kind of things have the potential to sort of even stop or make the business shut down. Now, the third kind of IP is copyright. This typically covers your original, creative works. This could be things like software code or things like online courses. Now, what can go wrong here? Last year, we advised a Series A tech company which had hired a contractor to write some part of the code for their core app. Because this agreement wasn't well done and it didn't include an intellectual property assignment clause, the contractor later sent a legal notice to the company demanding that they stop using the code. The startup had to eventually make a massive extra payment to the contractor just to buy the rights to their own software. I know it sounds odd, but this is something that happens much more often than you may think. Fourth that we have is trade secrets, and this is the least understood. These are your confidential knowledge and information that are contained in, just in company documents, not registered anywhere, and a lot of them are in your head or your employee's head. By having them assigned by the employees to your company, you can ensure that they are not used by these employees when they exit your company. So what you need to understand here is that investors are not just going to get floored by looking at what your deck says about your IP. They would want to know that it firstly actually exists, the company owns it, and then that it is not fragmented in the names of multiple founders or unprotected from your employees. So our suggestion here would be that you actually go back and check whose name that domain is registered in, whose GoDaddy account that domain sits in today, whose trademark that logo is registered in, or that brand name is registered in, and whose name that patent is filed in the name of. If it is not in the name of the company, then you should start the process to transfer it before you go to investors and you start pitching, because some of these things can take a couple of months, and if IP is very core to your business, they can be a condition precedent as well. So next we'll talk about people agreements. This is one of the areas where we find founders say that, oh, we've had that discussion, we are aligned. Oh, my co-founder is a friend from school, we don't really need an agreement, we are very thick. But those are things that really don't hold up when there are differences in thought process, differences in product direction, and so on. So principally, there are three types of people agreements that you have to be aware of. The first is the co-founders agreement that I just spoke of. This sets out what is the equity split between the two of you, which is also covered in the ROC filings, but this is also a place where you should put it. Who has what role within the company, who's looking after product, who's looking after tech, who's looking after HR, legal, finance, and so on, and who's looking after BD, sales. These are the things that go into this. And you also then put down in this document what happens when one of the people want to leave. The whole point here is to have a hard conversation now, put it down on paper while you all still are friendly and like each other, because if you wait for later, then it's perhaps going to be too late. And that should be the aim that you have with respect to this document, which is to prevent any dispute. The second kind of document is advisor or consultant agreement. This will set out the scope of the work that an advisor or a consultant will do for you, the status that they have within the organization, and what they are owed, either in equity or in consultancy fees. One thing to bear in mind here is that people who are working full time with you should be considered as employees and given employee benefits rather than being kept on as consultants for years on end. You would have heard of the new wage code, the labor codes that have come in, and now things have become stricter on this end. So you have to make sure that there is no employee misclassification risk that is there. The third type is employment agreements. This is for people that you actually end up hiring, and it should cover their compensation, their benefits, their role, the duration for which they'll be on probation, their duties, non solicitation clauses, and so on, and other basics of the relationship that is there between the company and the employee. Across all of these three agreements, there are three clauses which you should pay special attention to. The first is intellectual property, and we've just seen why that is important. The second is confidentiality, and this is because your team essentially walks around with all of your business secrets in their head, and they should not be disclosing them over a drink. The third is termination, because you want to understand very clearly what are the rights and obligations that are there, what is the notice period that is there on both the sides, is there any severance pay that you have. Now, to understand this better, let us look at two examples that we've seen just recently, right? The first is a deep tech startup that we had been advising. The founders talked through their terms only broadly over the months. They had started off, product development. They had gone to multiple expos and events and so on, but they never actually got around to signing a co-founders agreement. They kept pushing that over the past several months. One co-founder recently had a divergence of thought process, and they started building their own separate product, which was a little different from what the company was doing. And therefore, the development of the product for this company that we're talking about stalled. And now, next week, we're going to be sitting down with them and negotiating their exit. And the company is going to be shut down. They're going to have to start afresh. Now, all of this is simply born out from the fact that they did not reduce their understanding to writing. And then it became a match of he said and she said. The second example that we can look at here is a D2C startup where I got a call last week, Thursday at 11 p.m. The problem that the founder told me was that he had a lot of long-standing employees of the company who had never signed any IP or confidentiality agreements. They had an employment agreement, but they did not have any IP or confidentiality clauses, which should have kept pace with the growth of the kind of products that the company was doing. And he had been told just that evening, a couple of hours before, by one of the new joinees, that some of the old folks were planning to potentially leave with a lot of these trade secrets and with a lot of this data. So people who had been there in that journey and who knew what products were there, what is the supply chain like, who are the contractors, who are the potential customers, and what is the persona of the customers. They were going to set up their own company and do this themselves. Now, the takeaway here is simple. You should have that conversation, definitely, but then you should also move to the next step and get those papers signed and logged in your internal systems. The discussion that you're having is not going to hold up when you're trying to protect your business from these people. While we're talking about employment agreements and people contracts, it's also important to talk about the employee stock option pool that you've set up in your company or you're looking to set up. This is essentially the equity that you set aside to give to the people that you hire. And just like everything that else that we're discussing today, the issue isn't whether you've thought about it, but it's whether you've actually gone through all the steps that you can see and that we're going to talk about. Because without these steps, you don't actually have an ESOP policy in place. Now, for this, there are 4 steps, and you have to actually go through all 4. The first step is sizing the pool correctly. You have to look at how many employees that you're going to be hiring. What is your current team like? Do you already have senior folks? Are they already well paid and therefore they may not need to be given ESOPs? Or do you have less cash at the moment and therefore you want to compensate your new employees or your early employees with more equity? In which case you might want to have a larger pool. So typically the size of the ESOP pool is between 8 to 10%. And that can be determined in consultation with your advisors or people or other founders who've done it. The second step is having the scheme or the ESOP policy drafted and then approved by the board and through a shareholder resolution. This is the formal step that the company has to take that will ensure that the ESOP policy is in place and executed, and this often gets missed in our view. The third step is, once you've gotten the board approval and the shareholder approval, the policy will be executed and there will be ROC filings that you will need to do. And thereafter, you will issue grant letters to the employees who've been promised ESOPs. And then we come to the fourth step, which is something to bear in mind when you're going for fundraising. This is about the timing when you create the pool. The ESOP pool has to be created before an investment round. And this is because if you create the ESOP pool after the investors have come in, they will get diluted and they will not want that. So you should create this and it should be visible on the cap table when you are going and when you are signing on the term sheet. What we see very commonly in diligence is that we get cap tables where the ESOP pool is given. It's marked as a 8 to 10% with the founders having 70 to 80% and so on. And this looks like a nice slide on the pie chart. But when you actually ask for the documents and when you go looking for the ESOP policy, none of those have been put in place. And if the ESOP policy is put in place and executed, the ROC filings have not been done. And these things again become a blocker to the round itself. And what can happen in such a case? So if the shareholders, so what we've seen happening again in this example is that when the ESOP policy was not put in place, the shareholders agreement was stopped until the entire process was covered, and the money was actually wired only after the ROC filings were done. Now, to wrap up all that we've talked about today, what does all of this tell us? To get ready to raise funds, you have to essentially do a bit of homework, right? Your incorporation has to be in order, your people agreements have to be signed, your IP should be secured, and your ESOP records should be clean, your contracts, licenses, everything should be in place. What you see on the screen is what readiness would typically look like. And the reason I've built it in the form of a pyramid is because these things build on top of each other. a reconciled cap table uh, will not prevent your IP that was never assigned from blocking the round. Your ESOP, which is carved, doesn't help if the scheme itself was never adopted. When the investor opens up your data room, they are not looking at just one of these things. They want to see all of these things neatly marked, put in place, and that's what will really help you get through the round faster. And we've seen both of these sides in over the years. We've had founders who've opened a data room that was actually ready. Records were organized, agreements were signed, all the filings were done, and the diligence got over in a matter of 2 to 3 weeks. The investors' lawyers went in, and everything was done. The diligence report was shared with investors, and we proceeded further. And now we've seen the other side as well, where the data room opens up, and within a week, there is a list of 20 things that the founders need to do, the company needs to do. And each of these things that are there on either of the to-do lists as a condition precedent or a condition subsequent will again delay the time it takes to close the round. So essentially, what you have to do is you have to get your house in order before the data room is opened up and not afterwards. Now, even now, you have to understand that getting the house in order with respect to the data room is just a half of the process that is there. The other half is understanding the instruments that are there available to raise funds. And these are, the CCDs that you hear about, the convertible notes, the CCPS, and so on. And you need to understand which is the right one for the company at which stage. And for that, I'm going to now hand over to Smriti, my colleague, who's going to take you through these. Thank you.
Hi, good afternoon, everyone. Thank you, Abhinav. So, Abhinav has just walked us through how to be prepared for fundraising. Now, over the next few slides, what we'll discuss essentially is how do you structure that fundraising? So, oftentimes, I'm sure everybody who's tried to raise funds would have heard of terms such as CCPS, CCD, convertible notes, iSafe, and many other various versions of it. So in this session, we'll cover these instruments. We'll hope that by the end of it, you'll at least have a broad idea of what these various instruments are and what is the right instrument that fits your fundraise at the correct time. Now, there are a few questions that one must ask themselves before you decide which instrument you want to go ahead with. One is that how much capital is being raised? What is the stage of your startup? What I mean by that is that is it pre-revenue? Can revenue be determined? What essentially that helps us decide is whether we can have a valuation of the company at this stage, and accordingly instruments can be picked up. Also, what level of dilution are you looking at? Control, how much control? So investors, founders usually take a call basis these few categories. Now, before I jump on to each instrument, I'll just broadly categorize them into three categories. One, as you may be aware, the most popular is your equity or equity linked instruments. And so they are your simple equity shares that founders usually have in a private limited company. And there are certain equity linked instruments that start out as debt but convert to equity. Other than that, we have pure debt instruments, for example, non convertible debentures. What are these non convertible debentures? They are essentially debt with interest and they do not convert to ownership at any time in the company. So, keep these three categories in mind as we go and explore each of these options. First up is CCD, that is, as the name suggests, compulsorily convertible debentures. What are compulsory convertible debentures? This is a hybrid form of investment instrument and it starts out as debt, but it converts into equity. Now, there are various provisions that are related to it, and we'll come to why it is preferred during early stages of investment. First thing is that it mandatorily converts, and its biggest advantage is that it can either convert into CCPS or equity shares of the company. And the conversion usually happens after a specified period. Either it is at a trigger event, which is usually the next round of funding. Now, the question is never with CCDs, will it convert? These are compulsorily convertible, but when will it convert? So these are some trigger events that we record when we are issuing these CCDs. Also, now there are two aspects with CCDs. First, when they are used in early stage, uh, valuation can be deferred to at the time of conversion. But there are also many occasions wherein valuation can happen upfront. So it is something that can be fit to the circumstances. Secondly, terms are predetermined when it comes to CCDs. That is, what will be the conversion ratio, and the prices are fixed. One thing that we need to take care of, whether or not we have foreign investors coming in, because in case of foreign investors, we need to look at pricing, and we need to look at the conversion formula from that aspect as well. Now we move on to the next instrument, which is convertible notes. Now, what are convertible notes? Convertible notes are basically debt instruments that again convert to equity, but there are some things that differentiate it from a CCD. Convertible notes, firstly, only convert into equity shares and not preference. Secondly, these require certain eligibility. So, not everybody can issue convertible notes. The eligibility requirement for convertible notes are that you must be a DPIIT recognized startup, and the minimum investment size per investor per tranche should be at least 25 lakhs. So these are the situations in which you should opt for convertible notes. Now, convertible notes, again, the key features and advantages of it is that valuation can be deferred. What do you mean by this? Is that upfront at the time of issuance, you do not need to price your company or these shares. You can do the same at the time of conversion, and that is why it is something that's a very attractive instrument for investment when the company is at a pre-revenue stage, where it is very difficult for the investors or the founders to accurately decide on the valuation of the company. So that's when convertible notes are issued. Convertible notes also have nominal interest rates, and mostly these interest rates are also converted into shares at the time of conversion. Now, the maximum tenure for convertible notes are 10 years. However, what we have seen usually is that these usually convert in the next round of funding. Also, though they are debt instruments that can convert into equity, the one thing to note is that it's also at the holder's option. That means that if the company doesn't perform well, or if there is no next round of funding, or for any various reason holder chooses, these convertible notes can also be paid back along with the interest. So that's how they differ from what we discussed earlier, which is CCD, which is compulsorily converted. Another advantage, great advantage of convertible notes is that it's a very quick process. If you want to raise funds and not have too much time discussing your definitive agreements, your rights of the shareholders, the investors, and valuation, then convertible notes usually can close within 2 to 4 weeks, and it's a much faster process in that sense. And that is why very preferred for angel rounds, seed rounds, early investors. Next, we move to iSafe. You would have heard of the term SAFE, which so iSafe is nothing but the Indian version of SAFE, and this has been adopted uh, widely by 100x VCs, and they have introduced this concept and fitted it, I must say, to the Indian regulation system. Now, what iSafe essentially is, the name suggests, as the name suggests, it's India's simple agreement for future equity. What it means is basically it's an agreement that is entered between the investors and the founders, that is a promise for giving future equity. The equity is given at the time of next round of funding. And again, another thing to note, that usually these convert into equity shares. To adjust it to the Indian regulation system, since iSafe is not a recognized instrument under Indian laws, they are issued and they follow the process of CCPS in India. And now, what are the advantages? Why founders love iSafe is because it can be closed within 2 weeks. It's a 5-page agreement that you can sign with your investor. You can raise the fund, and you can worry about the valuation, about the terms, everything at a later stage when these are converting into equity at the next round. Also, another great advantage is when you have multiple investors coming in, you don't need to get all of them to sign one uniform document, agree on uniform terms. You can have multiple iSafe transactions simultaneously or one after the other. This is a great advantage for early stage startups, and that is why this has become a very attractive instrument for fundraising. Now, early on when investors come, they also want some certain advantages, and that is why these iSafe convertible notes. A lot of times, investors have certain terms that they agree to early on, which is that when these shares convert into equity, what will be the valuation? The next round's valuation now could be much more than what was anticipated at the time of investment. So how do these investors reap the benefit of investing early on, when which is the riskiest stage in for investment in a company? So what they usually do is they could agree to one of these three options. One is that when the shares convert into equity later, then the valuation would be capped. For example, if the next round of funding happens at 100 CR valuation, and if they have opted to keep the valuation capped, then what happens is that their shares convert at that capped valuation, which may be something like 75 crores. So this gives them an upside at the next round. Similarly, they can have they can also have a discount that they can agree to, or they can have a floor valuation. All these are contractual terms that are agreed at the time of signing the documents. So now I hope you have certain clarity on when to go for iSafe, convertible notes, CCDs. Convertible notes, again, like I said, there are eligibilities, right? So you need to have at least minimum 25 lakhs. You need to be DPIIT recognized. Also, there are interest accruing. So in those cases, to avoid those also, you can go for iSafe, which does not have any of these eligibility criteria and can be subscribed. Similarly, the valuation can be deferred, and that is why mostly most of these instruments that we have just discussed, they're all used at pre-seed series. Now, the next instrument that we'll discuss is founders and investors favorite, that is your CCPS. And usually we do get to see it in seed stages also, but mostly we see CCPS at the time of Series A and onwards, or when we have VCs on board. So what is CCPS? It's basically convertible preference shares, and they mandatorily convert into equity shares. As the name suggests, these are the key features. But let's understand that why is CCPS so popular among investors, and why is it preferred? As the name suggests, the word preference. So these are the type of equity, these are the type of shares in the company that come with certain preferential rights and benefits for the investors. The biggest advantage that an investor gets by investing via CCPS is twofold. One is that they do get to take advantage of the upside by holding equity in the company if the company performs well, but they also get downside protection in the sense that if there is a liquidation or an exit event, they get preference over other shareholders in the company to have their recovery and exit the company. That is one of the most important reason why CCPS is an instrument that is sought after in all the fundraising that we see around us. Secondly, CCPS, how it differs from every other instrument that we discussed is that valuation must be done upfront. It is a priced round, and the valuation happens at the time of issuance. It is a time-consuming process. We have seen CCPS rounds close up to anywhere between 2 to 3 months, because there's the term sheet, there's a shareholders agreement, lots of governance rights given, and therefore CCPS is a time consuming, but it is preferred because of the preferential rights that the investors do get, and also it is a priced round. Now, next up, as you may be aware, there are also government grants that help startups who are very early on raise funds. There are various grants by different departments of the government, like we have METI, we have DPIIT, we have Ministry of Defense and their IDEX. We have a lot of such schemes. Some things to remember about these schemes is that you should always have a lookout, apply to your sector specific schemes. And there is also something that you need to take care of, which is that these have eligibility criterias, and you need to apply through specific channels, often through incubators, and there's diligence and milestones attached to it. And though the money is very easy, but it is earned against certain conditions. And so this is also a serious part of your fundraising mix that you should consider while raising funds. Now that we have broadly covered equity and equity linked instruments, we'll look at how do you choose which instrument is suitable for your fundraise. Now, like I said in the beginning, there is no one right instrument, there is no best category. It is basically alignment over what fits, which is that depending on what is the stage of your startup, whether are you in a position to value, how much control do you want to give away, how much dilution are you looking for, immediate dilution, you want to defer the dilution. And then the third stage, like I said, is also tenure. Are you looking for short term, long term? Is it a bridge round? If it is a bridge round, then CCDs, convertible notes, are preferred over CCPS. And if you're looking for long term capital, then we have CCPS. And fifth is, what is its end use? If you want runway money, then debt funding is also an option that you can consider, which is usually non convertible debentures. So these are the various instruments that we can consider. I hope that now you have slight idea of each of these instruments. Another thing that determines which instrument you pick a lot of times is also whether foreign money is coming in. When the foreign money is coming in, certain instruments are FDI and certain are external commercial borrowing. So all these CCDs, which you see, since they convert into equity shares or CCPS mandatorily, they're usually looked at as equity under the FDI route. And there are also compliances that are required when foreign investors are involved, and there are timelines also. Plus there are certain price flooring guidelines that is there. That means that these shares, when they do convert, they have to look at that they're not below the fair market value and certain things like that. So having a foreign investor on board also helps you figure out that which uh, instrument is better for you. Eligible ones are CCPS, CCDs, convertible notes. Right. Now that we've looked at it, we'll also have a live term sheet walkthrough.
Right.
Abhinav, you're on mute.
Yeah, right. Sorry. Can you hear me now?
Yes, you're audible.
Okay, perfect. Right. So we need to understand first, what a term sheet is and what it is not. It is essentially a statement of intent that is given by the investors, stating that these are the broad economic terms, these are the valuations, and so on. It is also the foundational anchor which ensure on the basis of which the SHA and the SSA is going to be drafted. And this is where the founder should expect a lot of the negotiation to happen. Right. On to the term sheet. This is a term sheet that we've put together of a fictional company. It is Bumblebee Private Limited, the name of the company where a VC fund is investing. The name of the founders are Rachel and Joey. The investor is coming in with an amount of 7 crore rupees. And the instrument is seed CCPS, which is the compulsorily convertible preference share that we just spoke about. And the pre-money valuation is 50 crore rupees. Now, this means that at a post-money level, the entire holding of the investor in the company on a fully diluted basis is going to be about 12.28%. Now we'll be going through the main clauses in the interest of time, and also I just wanted to point out here that we typically get calls from founders once they have already signed the term sheet, and then they want to negotiate the SHA and the SSA. But what becomes very important to understand is that once these broad economic rights, as we've been talking about today, uh, they get signed on at the term sheet level, it's not going to be really possible to sort of reverse course and uh, negotiate them again at the SHA stage. Now, one of the important things that gets negotiated is whether the investors have a board seat or an observer right. Now, what is an observer right and what is a board seat? Now, an observer right is a person that is, this is typically the GP who's looking into that set of companies, or that sector of companies, somebody who understands the business. They will be appointed as an observer. They will be given all the information that a board would typically have access to. This is one option. And the other option is that the investors can appoint a nominee director as well. How this operates is that the agreement will typically say that when the board meeting is happening, the investor observer or the investor director has to be present for each of the board meetings. This ensures that none of the decisions are taken by the founders. Let's say there are two founders and both of them are directors. The decisions are not taken by them unilaterally without involving the investors or looking at their interests. And you will usually see that the right to appoint the observer or the director will continue until the time that they are invested in the company itself. The next point that becomes important is ESOPs. ESOPs, as we've been discussing, the investors want to align during the term sheet itself that the founders will maintain an ESOP pool of 8 to 10%, typically in that range. And we've discussed that it could be a greater amount as well. We've seen companies which are run by single founders have a larger ESOP pool up to 20-30% as well, so that when another founder comes in, they're able to give them equity which is vested over the course of years. Smriti.
So we also have certain terms pertaining to reserve matters. What reserve matters essentially means is that whether or not these investors, get a board seat, whether they become directors, observer, regardless of that, there are certain key decisions that impact their funding, right? And they just want to protect those, and that is why they want to ensure that no decision gets passed by board or shareholders unless they have, affirmative consent from these investors. And that is why, though most of the times term sheets will never have specific reserve matters, they're always captured in the definitive agreement, but investors do reserve the right that they'll be having reserve matters once they enter into definitive agreements. Now, also another thing that gets locked up early on is exit period and exit mechanism. What that essentially means is that investors are obviously looking to invest and then exit after a certain time, after an upside, right? So they do have a capping period, usually which is 4 to 8 years after their investment from the closing. That is the exit period during which the company is required to give them an exit. And there are various ways in which exit can be given to these investors. Some of them being IPO, strategic sale. A lot of times when exit is not given, then there are also situations that lead to drag along or buyback by the company. These are basically terms that investors and founders early on agree on what happens if within the stipulated time period, the investors are not able to exit the company. So then you agree to certain terms like a buyback provision, wherein the company is supposed to buy back the shares held by the investors, or the investors get the right to drag along all the shareholders of the company and sell it to a third party. Next up, that is also very important and usually gets missed. So, liquidation preference. Now, this is one of the most important terms in a term sheet, I would say. And usually, when founders just sign the term sheet and then approach, for advisory, and usually they come to us during definitive agreements, and these terms are already locked in. That's a problem, because liquidation preference is something that has a cascading effect throughout the life of your company. What it essentially means is that in any liquidation event, which is, whether there's a winding up of the company, or there's merger, acquisition, change in control, anytime any such event occurs, how, in what preference do the shareholders of the company get their money back? Now, investors usually lock those terms here, and what you want to be looking for in these documents is 1x non-participating. What that usually means is, in such situations, they get the investment amount back along with their unpaid dividends, and also and that is non-participating, which means that it does not allow for double dipping. So. 1x non-participating is the standard. A lot of times you will have seen term sheets with 2x or participating. The issue is that early on, if you agree to these with one investor, any subsequent investor that comes wants the favored clauses, right? So then this becomes a cascading effect, and that is why this is something that you need to look out for in your term sheets.
Like 2x non-participating can also happen when the company is raising in a stressed state, when they are running out of funds and they're looking to raise quickly, and the investors want more preferential rights.
Right.
Yeah. So next is anti-dilution. Now, this is not something that is understood very well. Anti-dilution typically kicks in when there is a down round. Now, what is a down round? So in this term sheet, we are looking at a valuation of 50 crores and the raise is 7 crores. If in the next round, the company is having to raise at a 40 crore valuation, that will be considered a down round, and the investor that is coming in this round, they will be eligible on a broad-based weighted average basis, which is one of the ways, as opposed to full ratchet, and they will be able to maintain their holding in the company. Now, this is the case when there is a down round. Now, when it is a round where the valuation is increasing, investors will want to typically exercise a preemptive right. Now, preemptive right, again, very similar, but on the other side, it means that when there is a follow-on investment, the investors will again be able to maintain their percentage of shareholding on a fully diluted basis by purchasing further equity.
We also, especially in early stage funding, we see that investors want to have the founders locked in, and something known as vesting and unvesting of shares. What this essentially means is that you have to earn your shares in the company by staying in the company. Typically, founders start out with 50%, if they're more, depending on how many founders, ownership already. So what typically happens for founders is reverse vesting, which means that investors are betting on the people behind the company, and they would want that you stick with the company and for a certain period, at least till the time their investment is locked in. And that is why they have these terms, which is founders lock in and vest in. What we usually see is vesting is 1 year cliff and 4 year period. So when we say that, what do we mean? That means, suppose you have 100 shares in the company. For 1 year it's a cliff, and after the 1 year from closing, you get 25% of your shares as vested, then you get another 25, and these 4 years you get your shares back. Now, how this impacts is that if a situation arises where a founder exits, and depending on what kind of a situation is it an adverse situation where you have voluntarily resigned but you've not gotten the approval of the investors, or any event of default, any fraud in the company, or any such situation that causes your termination. So how these shares will get treated also gets locked in during the term sheet, which is that your unvested shares, you lose out to the company. They get now, depending on whether it's good lever, bad lever, prices are fixed. So this essentially helps investors and founders both. A lot of times founders tend to look at it negatively, but we encourage them to look at it in this manner, that you may have a situation where two or three of you have started a company, and tomorrow one of you exits in an adverse situation. So this is something that is company friendly, rather it is just protecting against, you don't want somebody exiting the company, not and holding a huge chunk of the company. So that is why these mechanisms are locked in early. Now, there are also certain transfer restrictions that are there. There are terms like ROFR and ROFO. So we'll just explain what ROFR is. That is right of first refusal. What investors want is that if a shareholder in the company or a founder does transfer, firstly, you will be required to take consent of the investors in most cases. And once you do that, then also the investors want that they should have the first refusal over those shares.
Right. So on to indemnification, non-compete, and non-solicitation. Now, these are the clauses that you'll see in other agreements as well. Similarly, you'll see them turning up in your shareholders agreement and share subscription agreement. Now, indemnities are pretty standard. As Riti said, the investors are investing in the founders, so and in the companies. They're putting a chunk of money, and they are rooting for you to multiply their money. So they will want you to give some standard indemnities from both the sides. The founders will also be made to agree to non-compete and non-solicitation for different periods depending on the maturity of the company and so on. This essentially ensures that the founders are focused on building the product and the company that they are raising money from the investors for, rather than focusing on other things and taking time away from the business they're raising for.
Right. We also have.
Go ahead.
Right. We also sometimes have clauses like expenses, exclusivity, validity, locked in term sheets. What these usually decide is that, who bears the expense pertaining to the transaction, the stamp duty, etc. And you will usually want to put a capping on that amount. Next up is exclusivity. What exclusivity is basically one of the most common clauses that you see across the board in term sheets, which is your no shop clause. So when an investor has given you certain terms under which they're ready to invest, they don't want you going around shopping with other investors, for more slightly favorable terms. So that is why for a certain window they lock you in, wherein you're not supposed to be looking at other term sheets after you have signed this. That's your exclusivity. Another thing is validity, and you don't want the period to be too long because you want to the close early on with an investor so that you're not wasting too much time, and you're not bound by these clauses without any commitment.
Right. So I think that's the end of the term sheet and our speaking part of the session. Happy to take on any questions on the parts that we've spoken about and address all of your queries.
Thank you, Abhinav and Smriti, for sharing your valuable insights and practical guidance. So we will now move to Q&A sections. So our first question is from Amisha Yadav. She's asking, being at pre-revenue stage, generated approx 30K revenue in past 3 months. What should be the best approach to get the funding? And being more precise, should we even think of or consider for funding?
Right. So at this stage, given the revenue and given that I'm assuming the company just started off, institutional funding is not the right target. The realistic, target should be grants, competitions. You should look at the Startup India Seed Fund scheme, or look at some similar schemes. Look at talking to angels who are perhaps investing in your space. Angels can also help in other ways because they'll be able to open doors, give you some kind of insights once they've invested money. You should have certain milestones in mind, such that once you have hit a particular MRR, then you start pitching to larger institutions which can fund your business. Otherwise, you will always run the risk of chasing VCs, having those conversations, and then they'll keep coming back and telling you that you are not ready yet. and that we've seen ends up wasting a lot of the time of founders when they should be focusing on building the product.
Yeah. Our second question is Mr. Aniket Pandey is saying, building a sport tech startup, I started as an LLP because the compliance costs are lower, and I don't expect to raise VC fund immediately. My assumption is that most startups takes years to raise institutional funding. And if or when that happens, I can convert the LLP into private limited company. Does this approach make sense, or are there any major legal tax or fundraising drawbacks I should be aware of? Also, is there a practical DPDP Act compliance checklist for the early stage startup that I can refer to?
Right. So on the first point, with respect to converting at a later stage, now when you run a business, you're doing a lot of things, right? You are signing different kinds of contracts. You're getting employees, you're getting vendors, you're getting customers. If you try to do that once you've already run the business for a couple of years, you will have to transfer all of that. So if let's say you're working with a large enterprise which has a longer, vendor requisition form and that whole process, you will need to migrate all of that to your new company, and those things are not ideal. So my suggestion would be that you try to do it as fast as possible rather than putting it off for long. And if you do put it off for long, again there'll be those pitfalls where these things will get deprioritized, and you will first pitch and then try to address this issue. As for the data DPDP checklist, that's something that we can share.
Okay. Next is from Mr. Parth Gupta. What all is usually the part of DD if the startup or venture is really, really new, let's say about 3 months old?
Right. So it totally depends. Is at that 3 month stage, do you already have any revenue coming in? Do you already have any contracts that are signed? Is there any IP that you've filed for, any trademark, and so on? Now, so those are the things which will determine the depth of the due diligence. Um, and you will actually be raising institutional money only if you've hit some of those milestones. But if you haven't hit those milestones, if you don't have yet some revenue and IP registered and so on, you would be looking at raising money from one of the schemes, government grants or incubators, where the DD is typically much more easier. They will ask you to give a similar list, but they'll have a lower threshold that you'll have to comply with.
Next is from Mr. Sankalp Jain. He's asking, in pre-seed or pre-revenue stage, when the investor asks for the valuation cap for the company, according to you, how can a founder avoid the dilemma of overestimating the valuation or underestimating the valuation?
Right. So that is precisely what we discussed in, early stage. We do see this issue more often than not. Pre-seed, it's too early when you do not have revenue. How do you pick that what your valuation, pre-money, post-money would be? And what is advisable rather at that time is to use one of these convertible instruments that can convert at your next price rounds.
So, next question is from Sufi Upadhyay. He is asking, uh, we are building a FMCG brand, having a flagship product as coffee. What would be a major point that investors see in such category and brands?
Hmm. Can you come again, Tuleka? What are the
He's asking, he is building a FMCG brand, having a flagship product as coffee. What
right?
would be major points that investors see in such category and brands?
Understood. So yeah, so they'll first of all, like to understand the moat that you have. Now, the moat will be determined by a couple of things. On the business side, they'll want to understand how robust is your supply chain, how differently your product is, positioned as compared to your competitors. Where all are you able to place your products? On the legal side, they'll want to understand whether your trademarks are registered, and again the same documents typically with respect to your supplier contract. So if you are taking your supply from a particular coffee plantation, how long is that contract? What is the quantity? Do you have competitive pricing? How quickly, how likely is it that those contracts can get affected by moves in the market? So it'll be pretty much similar, and then there'll be some things which will be typical to your industry, which is the supply chain robustness and your ability to put it in the right place so that you can have sales.
Okay. So our next question is from Prashant. He's asking for a marketplace startup. How do investors decide whether to value it based on GMV or revenue? And are there any benchmark GMV or revenue levels that typically justify different valuation ranges?
Yeah, so valuation, see, it's been famously said that there is no science behind valuation, however much you try. It is something that it totally depends. Now, a couple of years ago, crypto companies were getting crazy high valuations. Last 2 3 years, AI companies were getting high valuations. This year is the year of deep tech companies because of the wars that are happening. So a lot of drone companies are getting high valuation. So valuation is that kind of a thing where interest in that sector really determines what the valuation is going to be like.
Okay. So, next question is from Mr. Arindam Das. He's asking an OPC private limited is also a right setup with all relevant compliances taken care of. Also, for the initial grants, is it focused on certain industries only?
So if the question is whether an OPC is the right setup, no, it's not the right setup, because again, it's a one-person company. In order to get investments later on, in order to have incubators or different institutions take equity, they will need to convert it into a private limited where multiple shareholders can come in.
Okay. So next is from Mr. Sandeep Jain. What concerns do HNIs and angel investor most frequently raise during early stage fundraising?
Right. So early stage fundraising, it's the same concerns that we've talked about today. At the very basic, they want to understand. The pitch is done by let's say one founder, and there's another founder in the picture as well. They'll want to understand how well these founders work together. If the cap table is clean, are there any co-founders who've left but they still hold equity? Examples like that, things like that. They'll want to understand what is the IP ownership that we talked about today. Is there an ESOP pool? And again, the different kinds of contracts between employees, vendors, customers, and so on.
Okay. So, Mr. Harsh Vardhan is asking what is the difference between the interest-free loan, CCDs, and convertible notes?
Right. So we covered some of it during our thing. I'll just help you understand what is the exact difference between these. Interest-free loans, they're pure debt, and they do not convert to uh, shares of the company later on. And whereas convertible notes and CCDs, so to give you what are the main differences between these is, first and foremost is that CCDs can convert into CCPS as well, or equity shares, whereas your convertible notes convert into equity shares only. Secondly is also the paperwork involved. So CCDs, is more compliance heavy, more legal diligence, and you have to agree to the pricing formula, etc., and the time of conversion that will convert to shares later on. Whereas convertible notes, have interest and they convert into equity at the next round. Convertible notes also, like we discussed, that they have eligibility criteria, right? So you have to be a DPIIT recognized startup, and the minimum fund size is 25 lakhs, which is not a restriction for CCDs.
Okay. So we are taking in the interest of time, we are taking the last question for today's session. Are LLP companies eligible for grant support from Mr. Somanath?
No, so you will not be able to get the kind of grants where there is an equity element involved. But let's say there is a grant which has no equity element to it and it's just a one-way grant, then you can perhaps get it. But again, it will depend on the checklist that the grant giving body has. They will want you to convert to a private limited so that later on there is a possibility of that same entity being able to generate value for the shareholders or in that sector where they operate.
Thank you, Abhinav, and thank you, Smriti. And I would like to request the participants that rest of the questions we'll take offline for this session also, and for the incubation and seed funding questions you guys have posted in the chat box. So thank you everyone for your active participation throughout the questions. And as we come to the close of today's session, I would now like to invite Mr. Karan Pratap Singh Rathore, Incubation Manager, Amity Innovation Incubator, Gurugram, to deliver the vote of thanks. Over to you, Karan.
Thank you so much, Sulika. Am I audible? I hope I am.
Yes,
Yes,
yes.
Karan, you are.
Thank you so much. Good evening, all of the founders, all of the panel members, um, everyone who's attending the session, and especially the Sigma Chambers team. So, on behalf of Amity Innovation Incubator, I'd like to extend our heartfelt thanks to Sigma Chambers for today's session on fundraising readiness and for early stage startups. Especially Mr. Abhinav Goyal, thank you for talking us through the documentation readiness with the precision of someone who has actually lived through multiple series A audit late at 11 in the night. And of course, after hearing about missing IP assignments and lost agreements, I think every founder in this room has just added a co-founder's agreement to their to-do list right after this call. And to you as well, Ms. Smriti Poddar, thank you for demystifying CCDs, CCPS, and term sheets as clearly as you did. And especially that non-binding suddenly becomes a lot less scary, and the reserved matters are a lot less mysterious post this session. This conversation also hit quite close to home for me personally because I've also worked for a VC firm before this and also at Amity Innovation Incubator. So it's the thing that the boring paperwork and the fine print everyone assumes it's these things that decide whether a deal closes smoothly or it stalls in months, right? But even across our portfolio, the companies that have raised cleanly were almost always the ones who had their cap tables sorted, their IP assigned, and their ESOP paperwork were in order, right? The ones that didn't, let's just say it's personally, we have fielded a lot of 11 p.m. calls in the night to sort out their paperwork and get them to be ready for funding, right, to raise a further round. So, but that those points hit quite at home, and that's exactly why sessions like these matter, right? So much for our incubator, for so much for our incubated founders and for all of the other founders as well. It's far cheaper to fix any problem in our documentation today with a room full of friendly faces than to fix it later in numerous data rooms full of unfriendly questions, right? So between us, we have gone from we'll sort the paperwork out later to we need to it right now, which frankly is the whole point of the exercise which we conducted today, right? So on behalf of all the founders here as well, thank you so much for your time. And on behalf of Amity Innovation Incubator as well, thank you so much for your time. Over to you, the moderator. But before we wrap up, I believe our speakers have also curated a checklist, which you'll find shared in the chat box. And thank you so much, Sigma Chambers. Thank you so much, Abhinav. Thank you so much, Sudhir. That's it from myself. Thank you.
Thank you.
Thank you.